Now here's a wide wing butterfly spread. This was on Microsoft. This was a long call butterfly. And again, why do you use this? It gives you profit, provides a wider profit zone when you do the wider butterfly. Again, structured for divine risk and hedging. Going to be used for what I call directional target swing trades. Also, these are great for what we call pinning trades, where we're looking to pin at a certain strike at expiration. These are really great for high volatility markets, okay? Because, why is that? Because we get our risk so low, and also really great for high price stocks, because we can trade really high price stocks at a very low cost with this kind of spread. Trade duration can be 1 day to out to 2 weeks in that kind of duration time frame. Always going to be positive data, no time decay, returns of 2 to 1, 10 to 1, 11 to 1. These are just incredible potential returns at certain points. Okay, so here's the one that we had set up on Microsoft, a kind of alert trade here. So it says here, new Microsoft long trading at 280.40, looking for a break over 283. So then I put in the upside target 290, 295 to keep risk low. We use a long call butterfly. So here it was. Here's buy the butterfly, the 6 April series, the 285, 290, 295, $5 wide. Look at that cost, 75 bucks, right? So that's your total risk. If everything went wrong, you'd be losing $75. Okay, so here's where it ended up now on the 31st. It was now trading, it was up about $45 per spread, and then went up more and more and more as we got closer to expiration. So this was a butterfly. Let's take a look. So here's where it's set up. Just kind of going through the kind of the picture, what it looked like at the time. So you can see we came down here, we held this kind of moving average. My momentum indicators were shifting up. So we bought it right here on the 29th. It's trading at 280. Then we popped up here. We had a profit there on the 31st. So take some profit, and then also ended up here. So we'll kind of layer out of the profit take. You know, you have legs of it. So you get out and then reduces your capital at risk by taking some profit, and you leave some for the expiration, which is where you can have your potentially max return. So that's what we're kind of shooting for, if we can get into that return on the max, expiration day. So here's spread. You can see what it looks like here. So we were kind of targeting up to 290. So we had bought at 280, targeting $10 up. So we had the 285, 290, 295, $5 wide spread. Cost of the trade $73 per spread. That's your max risk. So potential theoretical return would be 427 or 585% return. Risk in a dollar to make 585. So great return on risk, right? So here's your max risk, potential max return. And then if you get anywhere in between, your returns are fantastic. So, we're never shooting for the max, but sometimes you'll get pretty close to it. So let me get rid of this drawing tool. So then here's where it went out. So here's the butterfly on Microsoft, and here's where it went out at expiration. It's trading right there, right at 291.76. That would have been perfect, but this is close enough. So here's your profit zone in here. So this went from the spread of 324, blew out to 324 less the debit cost, so $251 per spread, 343% return over an 8-day period. So really hard to beat this kind of trade. So trade durations on these are typically, could be 1 to 2 days to 1, maybe 2 weeks out.